Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, active, passive, maybe you're just somebody that's in the industry, you want to learn more about the apartment market, well, fortunately for you, you're in the right spot because we're going to be breaking down all the latest research reports, data, articles, and I'm throwing out some original opinions on the multifamily industry, real estate, commercial real estate and residential, but also, the macro economy and how it affects everything, really vice versa, because it's fascinating how real estate absolutely does affect the macro U.S. and global economy. And today we are talking about a lot of just macro fundamentals that affect housing and multifamily apartments. So we've got some great reports. First off, from the Harvard Joint Center for Housing Studies, they've got their 2024 just big state of the nation's housing report that they put out every single year. So much packed into this report. We're just going to kind of brush on the surface a little bit on a couple key points that we want to discuss, how it all folds into the overall story of how apartments might perform over the next decade or more. We're going to be getting into more details on that report in future episodes, and make sure you're subscribed to the Gray Capital newsletter, the Gray Report, by going to graycapitalllc.com/newsletter to sign up, and then we'll send you that report amongst many others directly to your email. But also from the John Burns Research and Consulting Center, how will the declining birth rate impact the move up in housing sentiment? So we're going to be talking about the birth rate, what it's been like over the last couple of years, also go back decades, and how that may impact real estate. But then also from Associated Press, really just going to the conference board, U.S. consumer confidence falls in June as Americans fret about near-term prospects. Again, we're talking a little bit more about the vibe session, how you feel versus the reality. It doesn't always line up, but we're going to see kind of what that consumer is feeling. And then we're going to wrap all this together. And again, how it might affect apartments, how it might affect the economy and interest rates, so you can make some really well-informed decisions. Well, enough about me reading off some lists. Let's get into the reports. Welcome back to the Gray Report, joined again by producer and director of communications and marketing here at Gray Capital, Dr. Matt Bosnagel.
Hello.
How's it going, Matt?
Pretty good.
Nice set of reports. As we were going through them today, Matt, we really said, there's the big theme here in a lot of these reports is we've got some just macroeconomic findings and really some macro fundamentals that, a lot of times we are looking at, the rent growth from, this last month or something really high frequency data. And we're kind of stretching out that period a little bit and looking at some more long-term drivers that may not affect everybody today, although some of them might, but really looking at how this will affect the market and the industry for the next decade to come. And starting with the Harvard Joint Center for Housing Studies, their State of the Nation's Housing 2024 report. This is one that we always look forward to. But before we get into some of the details, and there's just a couple metrics that we are going to kind of pull out and discuss on this conversation. Again, what's this next decade look like? But there's so much in this report. It's 50 pages, full of graphs, articles, analysis. And again, you can get we're going to send this to you if you sign up for the Gray Report newsletter at graycapitalllc.com/newsletter. But Matt, again, before we get into it, tell us a little bit more about the background on this report. We always like a little bit of context. And because they're coming, Harvard Joint Center for Housing Studies, the JCHS, they're not, how's the best way to say this?
Not industry insiders.
They're not industry insiders. They're academics.
Yep.
They're not, a lot of the reports that we report on, discuss here, are produced by folks in the, again, best way to say it, more profit-driven sector of the industry. And so it's companies like Yardi or RealPage that offer, software as a service, for, property management software and data analytics for real estate investors and owners and property managers, or
people for whom rent growth is a good thing.
Yeah, it's that's probably the easiest way to describe it, Matt. Of folks that see rent growth as a positive thing for their business and the growth of the industry.
I caught myself last week saying, I was like, no, it's only like a fraction of a few where rent growth is like good news for these operators. But yeah.
And even in the Wall Street Journal article, Matt, that we discussed last week on the Gray Report. Just the reference to rent increases as rent hikes. Like hike is like interest rate hike, rent hike. It's not a doesn't seem like it's not a good thing. Like rent growth is much more attractive from the investor's standpoint. It's a good thing. It's going to put some money in your pocket as opposed to taking money out of your pocket. So Harvard, they're looking again. They're much more going to be looking at this from the consumer standpoint and really focusing on housing affordability. And I think including the Harvard report, as we do all the time, is a really nice juxtaposition against some of the industry data and coming at it from a different angle. And again, really zeroing in on affordability rather than just profitability gives us, I think, a more full spectrum take on state of housing.
Oh yeah, and in many crucial ways, this is an essential report to get this perspective.
I think it is,
and to understand, maybe you're not, even if you are an industry insider and you're like a landlord and you're not renting affordable units. Well, it's important to know the affordability pressures that are happening, and maybe the places where maybe they're not happening so much. And I kind of want to talk a little bit about that in this Harvard study. I don't want to say gaps in their research, but places where it's like outside of the data that they currently have.
Just before I want to jump in and then ask you kind of what are some big takeaways. Again, there's just so much to get into, and as you were kind of giving me a brief on this report, Matt, you said, fortunately, unfortunately, it's not necessarily a lot of new information. If we're talking about information that we've been talking about in the Gray Report, we talk about it all the time. And it's like, here's an example, but again, it's just, how many times have we seen one data print and it's just not right? So we'd like to see different sources. So, just this first piece, looking at, housing costs have remained elevated after the pandemic era surge. If you're listening, we're looking at a graph. Looking at asking rents relative to home prices, going through 2014 all up to 2024, so the last 10 years. And, as you can imagine, basically up until the pandemic, rents were always a little bit higher than home prices. Which made sense. People always say, if you can buy, build some equity, because renting is going to be a little bit more expensive. It makes sense. If you lease something rather than own something, you usually are paying a premium for just that short-term use of it without all the headaches of ownership. But starting the pandemic, we saw this big divergence with first rents just kind of flatlining during 2020 because no one knew what was going to happen, and there was eviction moratoriums, and it was crazy.
At the same time that
these housing prices started to spike because interest rates were zero and people were like, I need more space because I'm in the pandemic. It wasn't until the end of 2020 and really into 2021 where landlords turned around and they said, wow, not only are people still paying their rent because of all these stimulus checks, but in fact, there's more housing demand than I've ever seen. And my property, because no one wants to move around, my property is now 98% leased or 100% leased. What do we do when that happens? Well, we raise the rents. And that began the huge increase of rents starting in 2021. But even with that big run up, it still pales in comparison to where single family homes, and then rents basically stalled out, halfway through 2022. Single family homes, they did a little bit, they declined, but now they've been going back up in price. Where rents are basically kind of flatlined since, kind of halfway through 2022. I mean, we talked about this a lot, just the difference between renting and owning and how it's a great time to rent.
You may have heard me say, wow, Lil, I haven't seen this graph in a long time, and it's a stark reminder of how much home prices have are clearly more expensive than the rent growth that we've been seeing.
Yeah, inventories are low. Not that there's a ton of volume of sales out there, but the sales that are occurring are elevated. People who need to buy something, they apparently have the budget to do so.
Yeah.
Where with rents, again, we're seeing a record amount of supply coming online. That's really putting a damper, but we're not seeing declines, and so this is really setting the stage for, again, another. And this is probably more medium term than really long term. But given the fact that we will see supply tighten up closer to 2026, not right away, and probably maybe not even as extreme as maybe some are saying, but we're going to see supply tighten up significantly over the next 18 months. We should start to see some reversion. I'm not saying that because I don't see the single family home prices falling in price.
Yeah.
Because you could say that like, well, okay, the home prices need to come down. That's where we're going to even things out. It doesn't really seem like that's going to be the case. You see these lines typically are moving somewhat in lockstep. There's a little bit of delays here and there, but there's a lot of correlation. I think the rents have to come up and at least meet that the home value, home prices in the middle.
Yeah.
And so that's going to be a big move in rents over this next decade that everyone, apartment operators, investors, LPs, GPs, everyone's a little shell shocked from the last year, Matt. Everyone's used to no growth, low growth. And even if you like me and said, okay, yeah, the next year and a half are probably going to be slow, but after that, I think we're going to see a lot of growth. Can't really put a big number on it.
Yep.
But a lot of people are saying, I'm never going to assume there's ever going to be any rent growth again. And that's just ignoring just the facts of history.
Yeah. It's a reminder that all housing demand, housing kind of lifts all boats, and you can see this increase in home prices as a sign of the high housing demand in the country, and the fact that it has risen. I think it's a strong sign that there's going to be further rent growth, but it's also I think, like you said, a sign that the increase in multifamily supply really did have an effect.
Yeah.
In a way, maybe the rental market is a little bit more responsive, it seems like, to the pandemic pressures of demand and everything like that. Whereas the housing market, there's much fewer sales because of the high interest rates, at least, and the construction activity is it's higher now, but it was been a little bit lower. It's a little bit different worlds, and it's way easier to just see it as housing demand than I even just tried to. I tried to tease it apart, and I was like, you know what? It is too complicated. I don't think anyone's trading out rents for homes quite as fluidly as people say, but it's just good to see these as signs of demand.
Yeah, absolutely. Then just, again, because we're on the affordability conversation, looking at cost, burden, homeowners and renters, looking, based this on millions of residents in the United States. You definitely, and there's no data for 2020, but homeowners were basically kind of declining cost burden kind of ratio really since like 2011, where homeowners were more cost burden than renters, and that shifted, and then really kind of the renters were becoming slightly more cost burden, with homeowners, I guess they're building equity, less so, and that the cost burden has gone up for both homeowners and renters in 21 and 2022, but certainly we've been past the 20 million mark for renters really since 2013, and I'd say that it's up slightly compared to 2013, but not dramatically elevated, and not as many as homeowners that were cost burden really from 2005 all the way through 2011.
The kind of like the great housing crisis kind of. But it does look like, so right now, yes, renters, there are more cost burden renters than homeowners, but it does look like that gap is shrinking.
That's true.
There's a slight increase in the amount of homeowners that are cost burden, and
I think that begs the question to the last graph, Matt, is though, okay, well, it seems like the prices of rents need to come up, but can
very good point.
Renters afford those increases? Can anyone afford those mortgage rates? I mean, we've been surprised in the past. We had the same conversations before the pandemic, 2018. How can any renters afford any more rent growth? And then rents grew by 30%. So I mean, we can certainly be surprised, but also not surprised when we see that there's a lot more people that are cost burdened. New supply of apartments is outpacing rental demand. We know this. We've mentioned it. We talk about it all the time. but there is a lot of new supply that is coming online. You can see these new apartments completed, versus net change in occupied apartments.
Yeah, there's other points that they made too, like particularly one that was promising, really, is household growth. I think this is very good news. I see households as a really salient indicator of housing demand, really kind of the downstream effects of economic growth, population growth, income growth, all those primal forces that actuate the housing market down the line. And if you skip to page 18, which, oh man, you already have, you can see that despite maybe some worry about demographic shifts away from the huge number of baby boomer households into the smaller Gen X, millennial, and Gen Z households, we're looking right now at the numbers for household growth from 2010 to 2023, and the household numbers are appreciably bigger now than they were in the 2010s. There isn't a huge decline. There was a decline from 22 to 2023, but we're still way above where we were in 2018, and the general trend is up. I think that's really promising. I still think that broader population trends are relevant and worth watching. Like, it is true that baby boomers were a big part of the population, and they aren't going to live forever. And there are smaller generations than the baby boomers that
Don't
are
tell
now.
them that.
Yeah, well, actually, maybe they will live forever. Well, millions now living, but I don't know. but notwithstanding that, there is still a lot of people that are going to need housing. I'm always worried about these, if we really are, and this has been in the conversation a little bit for the past few months, and maybe it's just my own looking at it, but like population growth is not what it used to be in the United States, whether it's birth rate or whatever. Immigration's a little bit more volatile because that can change based on what policy you have. But for the United States, population growth not as strong, and in 18.
Your point about immigration it makes sense. It is worth mentioning, though, is that that immigration has kind of backstopped some of that lack of population
and
growth.
it becomes more important in a larger portion of your population growth as birth rates decline. But even so, I think that right now the housing undersupply is way bigger than any of these slight changes in population. However, it's not going to be like that for all time. I keep wondering, at what point will we intersect? Will we ever? Maybe the economy will adapt. Will we ever go from, oh man, there's a massive undersupply of housing's unaffordable, to, oh, now population's declining and we don't need as many houses anymore?
I mean, that's what it's like in Japan, essentially.
Yeah, and also I wonder, like, depreciation might have a thing too.
I think if we are, as a country, kind of open to immigration and doing it in a safe way that makes sense, I think we'll fare okay. Because one, as a country, we're innovative. I mean, going through this whole AI revolution, who knows what things are going to look like in 5 years. But I think the United States of America is always going to be a place where people want to come and be. And so I think we've got it's not necessarily, the birth rate isn't, as a self-sustaining, if we're not going to let anybody else in. Well, and people, you can leave, and we're going to have less kids and less babies. I think we'd be facing a much harder challenge. But if we are open to saying, hey, look, qualified to work here, you want to work hard, or if you get a degree here, you can stay and keep a job, whatever it is. We're gonna be able to sustain a much more balanced, growth, over time. Whereas other developed countries such as Europe or Japan, they're not seeing that influx. It's just not an option. And so I think that it will bode well for us. I popped up this immigration surge boost population growth just because it's relevant, Matt.
I had no idea that the numbers were this stark. How much? So what, for now, it looks like natural increase of population for 2023, natural increase of population was responsible for 0.5% of the population change. I'm sorry, 500,000 population in population change, and immigration was responsible for, let's say, 3 million,
3.5.
Wow.
Yeah, 3.5 million.
So that's like seven times of the natural increase. I had no idea. This is I knew that it was becoming more important.
It's a big deal. I've been talking about this for a while.
Yeah.
It's a driver. And again, outside of housing, where these people are going to live, but from a standpoint of we've got all these jobs that we need Americans don't want to do, and we need a cheaper labor pool. And with inflation, we had not enough. We had too many job openings, not enough workers. Where are the workers going to come from? Because all the American workers, they're all stuck, working from home, and they just, they want to get their Starbucks delivered for them and work on Zoom all day. But there's other jobs that need to be done that can't just do that for.
Agreed.
Well, there's so much more in this report, Matt, and so we'll earmark it for next week to continue to jump in at some of these other data points, because again, there's so much packed in here. But also, if you want to just get ahead of the game and read this yourself, sign up for the newsletter. At greatcapitalllc.com/newsletter. You can find this report on Harvard's website. You can Google it, but signing up for the newsletter.
I wrote a whole lot of notes for this. I'm not going to be able to read them. I'm a little disappointed. So check out the Gray Capital blog for my full write-up on this, just so I have
Matt,
somewhere to share it.
We don't push the blog nearly as much as we should, but Matt does full write-ups. Prepares great notes and summaries over all these articles, and they're all available on the Gray Capital blog, greatcapitalllc.com. Can we even say just women? Let's talk about declining birth rates. I think that makes more sense relative to talking about population growth, immigration, and again, why this is why it could be important, and again, how it's going to affect real estate over the next couple decades, Matt.
So this article really kind of sketches over how, whether it's lower birth rates, having children later in life, regional differences in migration, all these kind of and really the uncertain factor of immigration that we just covered, that was unmentioned in this article, but it was definitely worth mentioning. It's really just a lot of these different considerations that happen at the intersection of housing and population growth. And these are very much like kind of ground level stuff. For instance, like maybe people are going to move they're going to be moving around, so they'll move from a higher cost of living with a little house to a lower cost of living with a big house. It's a slow burn for a lot of these population trends, but I think that it's difficult to get a sense of where things are moving if you're always looking from day to day. And it's nice to have this reminder that, oh wow, this is how much births there were by decade. In the 2020s, 37 million. That's the projection. 39 million in the 2010s. In the 2000s, 41 million. Now that 41 million is particularly relevant because those are the people that are probably renting age at this point. You don't, and what's interesting is you don't see a number like that 41 million until the 1950s. So is that me, or is Gen Z more births in that decade? The Gen Z decade has more births than the 1950s baby boomer decade? And that puts the lie to my whole declining demographics thing. So it's a little encouraging. Again, I would be encouraged by some of these population growth trends. We're not crashing into a cliff, but yes, it's a little
that it's flat.
Yeah.
It's a little flat, but it's not as dire as it could be, because there were a lot of births in the 2000s. But since then, over the last 2 decades, there has been declining. Again, it was worse in the 1970s. It was slower in the 1940s and the 30s, but obviously then we're going back 100 years at that point. And the overall population was a little bit smaller as well, and they were having more kids at that point as well. So our population certainly has grown, but we're having less kids. And so if you think about it that way, like our population is much larger in the United States than it was in the 1950s, but we're having about the same amount of kids.
Yeah.
So the volume is there, but it's really that rate, which is not great. But what is this? I think obviously looking at future population growth and, just how many heads are there? How many beds do we need for all the heads? Beds for heads. But also, this a whole idea that people, it says women, but like people, persons, whatever's politically correct, Matt, have
childbearing people.
Childbearing people. They are having kids later in their life. Where in the 1990s, birth rates were the highest among women 25 to 29, but by 2023, women aged 30 to 34 had the highest birth rates.
Wow.
that's a big shift.
Yeah.
And what that also I think means for apartments is, or there's having a kid. If you have kids, you know that having your first child is there's no other life event that I think changes you more than that. Because even getting married, it's like official, but you've had that same relationship, and it's just the status has changed. You change it on Facebook or whatever, and go down to the courthouse.
Starting my job at Great Capital.
Yeah, there we go. But
no, I agree.
Tell the twins that. But having a kid, you have to think a little bit differently, and specifically, just logistically, you need more space usually.
Yep.
Like you need it. Often it's nice to have another bedroom, and you just need more room. You need to spread out because you're getting the toys and the stuff. You need all the gear.
And you don't want, maybe you don't want to share a wall with someone if you can afford it.
Yeah, you start asking yourself questions of, what kind of life do I want my kids to live? I was fine sleeping on the mattress in the corner, but like, do I want it? Well, I see my kids sleeping on the mattress in the corner? Maybe not.
And maybe you're making decisions about, well, do I want to commute to work now and move to a school district, or move to a place that has cheaper houses so that,
all of these questions start emerging in your brain. And so again, it's a decision of saying, okay, I was in an apartment. Now I need to think about buying a house. There's a reason to go and buy a house, even though houses are hard to buy right now. But again, even taking the affordability out of it, this is really looking at choices, life choices.
Yeah.
What this means to me is individuals are going to be staying in apartments longer because the decision to have kids is often highly correlated with the decision to buy a house. It's like, if we're going to be spending a lot of money, why not just destroy the budget, buy a house and have a kid? But so if you're not going to have a kid until you're 30 to 34, that means that you might be staying in an apartment for a couple more years. And that means there are historical understanding of what demand is, and just that consumer behavior, we need to adjust our thinking. And there's going to be some slightly older individuals living in apartments. It's not just going to be folks that are graduating from college and the current Gen Zers. But it's going to be a little bit of a wider mix. And I think that this is positive for multifamily for the decades to come. There could be a reversion back. I mean, there's like there could snap back, and people having kids much earlier and having a lot more kids. I mean, there's sort of that. There's some like inklings of like a movement for that, I think, for some people, but I think it's pretty niche.
No, I completely agree. I think that, yes, like affordability is preventing a lot of, I used to say this so many, would-be home buyers. It's preventing would-be home buyers
would have been home buyers.
And that is an effect that is very, very valid. It's real. But I think a lot of times the affordability issues mean that, man, you've got to find a home. So maybe you're moving out. Maybe the home's going to be smaller. There's a lot of different ways that people can solve the affordability. Now, I agree. For a lot of people, it's unsolvable. But there are options. If you can't afford this house, well, there are other houses out there sometimes for a lot of people. It's just hard to talk about, and kind of going back to the Harvard Joint Center Housing Studies, it's hard to talk about affordability without painting a little bit of a broad brush. But I do think that when you're talking about birth rates and population growth, and especially life stages, I feel like for any given person, it's not necessarily the amount of money that you're making that's going to say, all right, it's time to buy a house. It could just be that's where your life is. There's a lot of rich people that rent apartments, maybe because they're in a different stage of life. Almost positive. They're lifestyle renters. They have a different lifestyle. Maybe when you have kids, your style of life is going to be different. You're going to buy a home. So I think that's a really valid factor to think about. Frankly, just the age of someone.
It'll be interesting if it'll be interesting to see how kind of the BTR, those developments, the build to rent that progresses, because those starting to pick up before the pandemic. But it makes sense because there's going to be folks that, again, having the family, need the space, but you don't want to or can't afford to purchase a home outright and what finance they can't afford the more down payment or the mortgage payment, and renting might just make a lot more sense. Even if it's for a family and you're getting the same essentially type of product, you just might not be able to make as many of your own holes in the wall. But believe me, you've got kids, the holes in the walls will find their way there.
Some are bigger than others.
Some are big. Yeah. Some are easier to fix. Okay, wages, Matt, wage growth tracker in context of looking at where we are fundamentals. How are we going to pay for all this?
Well, yeah, and we'll cover some consumer confidence numbers too, and this puts the numbers to the sentiments as well. I initially brought this up because I was thinking about the affordability and how one of the figures from the Harvard Joint Center for Housing Studies report was how affordability is still decreasing for renters. And my point really was, okay, so right now they have wage growth for the lowest quintile at 4.9% year over year. Right now, the CPI is measuring rent growth at 5.4% year over year. Now, we know that the CPI rent growth is going to trend down just because that's what the more state-of-the-art rent trackers are saying.
Higher frequency, more real. Not even state-of-the-art, just like actual numbers versus something else.
Yeah. So the clear view, the more like up-to-date contemporary view of rent growth is it's been flat for a year. CPI measures it at 5.4%. So somewhere between that 5.4 and the dead zero we are now, that's where rent growth kind of really is going to head and be. Now, is that 4.9% income level? Even if that comes down, it's got to drop significantly for it to come under rent. So my point is we will very, very much get to a point where renting is becoming increasingly affordable, unless the CPI rent measurement just comes and goes in its own direction. And then at that point, it's whatever numbers you want to pick. Do you want to pick the apartment list numbers? Because that says rents are getting more affordable. If you want to pick the CPI numbers, we still have 0.5% to go.
Yeah, well, I almost ignore the CPI numbers other than it's a number that somebody else pays attention to. But I think the bottom line here is that we've seen a ton of wage growth over the last several years. Wages are still growing, although the trend of growth is down. So we're growing at a slower rate, but we are growing at a rate that we haven't really seen since, going back to basically 2000. Wow, before 2000 or in the 90s when we saw wage growth at these levels. Again, I would anticipate that we will continue to see declines. But what I'm more bullish on this chart, though, Matt, is the declines. Again, I think it's there's good news and bad news, which is actually good news, is that the decline in growth is a really good sign for the Federal Reserve relative to what they're going to do with interest rates and the Fed funds rates, because this whole idea of a wage price spiral is really how inflation can get out of hand. And you can imagine, as we were discussing on the Gray report back in 2022, that wage price spiral was all a possibility. And while wages are still growing, the unemployment rate still is at a record low number. We are not as growing as strong. There's not as many shortages, and I believe the language that Jerome Powell used at his last FOMC meeting is, we're kind of getting back into. I'm completely paraphrasing. I'm not quoting him. But we're starting to see some more signs of like a normal job market. It's still tight, but it is not. It's appearing a little less tight than it was. Which again, it's a sign of the right direction. It's progress.
I didn't even. I'll be honest. I wasn't really thinking hugely about wage growth. It's really, I guess in light of inflation, the wage growth stories really aren't at the top of the news compared to like what we had, like 7 and 9% inflation and stuff like that. But wage growth is higher than it has ever been for 20 years. So
it's because of inflation was so high and it didn't really feel that great. And but I remember it because everybody coming in for raises, and we gave everybody a raise. Because the inflation. So now it looks like we're going the opposite direction. I wonder if it cuts both ways.
Yeah, it does. I
don't think so. But this is good. Good. There's two good stories. One, it bodes well for interest rates, but also just for the consumer and the average person making more money is a good thing. And again, for it's a double win for multifamily owners because wages go up. That means rents can be paid, and if interest rates come down, then everyone can refinance their deals, pull some cash out, or just save your deal if you overpaid over the last couple of years. So that's good for those folks.
For real. So
we need to do another loan maturities report, Matt.
Yeah. Update and see see how things are going.
We produced 2 blockbuster reports on loan maturities. Some of the first commentary on the subject. I mean, now it's like for us, it's like old news.
Yeah.
But now there's a lot more that's starting to peak up of foreclosures because basically the extend and pretend, and I'm off topic. I'm going on a rant.
It's fine.
But the extend and I had a couple of good conversations with lenders this week, and I think banks are starting to get impatient with extend and pretend. It seems like.
Yeah, I've been reading some headlines about that very thing. Is how banks are trying to. Are getting nervous about the CRE loans that they have on their books.
Yeah, because they want to make new ones. To be honest, and they're like, we got to get rid of the ones we've already got. You guys keep giving us the runaround and saying, oh, we're going to get it back together, and just got to wait for interest rates to drop. Well, they haven't dropped yet.
So speculatively, then, because we don't have a report yet, what happens when banks they want it off? They've been extended. They've been given the guy or gal a relatively easy way. They know that he's got a struggling property, but they've reached the end of their rope. What's the next thing that the bank does? Does it foreclose? Does it say or does it say your rates are gonna go up? So you either figure it out or we're gonna be the one that owns the property.
I think they've been saying that in a nicer way.
Okay.
But yeah, they could foreclose on the property. A lot of the values are basically what the debt is, and so in some cases they are trying to sell the assets, and either the owner has to come to the table with cash, to finish paying the loan off, or they're just breaking even. And but in other cases, they depending on how it's being managed, there have been foreclosures, and there will be more foreclosures. I was reading about a foreclosure auction recently, so that there's deals that are being taken back, and it seems like that rate is increasing. I think CLO delinquencies, which CLOs, collateralized loan obligations, these are the package of bundled mortgages that have been securitized, but specifically for multifamily bridge loans. Delinquencies are up quite a bit, relative to like CMBS and some other loan products, which are a little more publicly available information, but typically longer term loans, also relative to bridge loans. So the distress and a lot of the challenges that we identified with all these loans that were coming up to mature, it basically was shifted. That danger just kind of got shifted a little bit in time, because all the bankers said, or the lenders were like, let's give you another 12 months because we're reading in the headlines there's going to be this is back in 2020, end of 2022, early 2023. It's like we will have a recession in 6 months, and rates will just come down then.
And we covered the guidance from the government that said, hey, here's what you guys got to do is give them a break for a little while, and I wonder what the guidance would be now. Would the same people, the same authors, I think it was the Federal Reserve that wrote that, what the Fed would say to banks now, should they continue with that guidance? Now, they issued that guidance for a reason, and which meant that they wanted to change behaviors to a different behavior to make them more forgiving. Do they want to revert that change back, or do they want the banks to always be so forgiving?
I think that they would prefer, if the banks can work things out, that is good for everybody. I believe that is their stance.
Okay.
If they can work it out, because if you could see some sort of contagion effect of like, hey, no, they're foreclosing on their multifamily properties. We have to foreclose on all of our multifamily properties, and then.
But like I know, and this is only it's like it's words are cheap, I guess. These zombie loans, zombie properties that could be propping up. So what's the damage of a zombie property versus the damage of contagion? Zombie virus.
Well, if it all, every case is a little bit different. I mean, one, you're not letting like the market really like work itself out, and you're delaying the inevitable.
Yeah.
And that's not usually like a great thing. You'd rather just work it through the system sooner so it can start to recover. And I bet the properties aren't going to be managed that well, and so I think it's a disservice to it's a disservice to the people that live there. I think it's a disservice to investors because like they're going to lose it. They've already lost their money. It's just like, are they going to wait to write it off on their taxes for another year or two? So I don't know if it may help a sponsor like sleep for a couple. I don't know if they're sleeping, but they can just delay that bad news. Maybe they can do another deal or something. I don't know.
Interesting.
It is fascinating. All right. So that is kind of a roundup for some macro updates. We're going to get into more information relative to the Joint Center of Housing Studies annual report later on. Two other just kind of side reports, Matt. What do you even talk about? And this is sort of macro, sort of behavioral. So we'll lump it in.
Oh yeah.
So it's from Apartment List, and it's about these super commuters. We've talked about these folks in the past. It's sort of related to work from home, but the opposite. We've added 600,000 super commuters in 2022. First off, Matt, this was the graph that I found interesting, and because it kind of marks the trough or the peak, I don't know, however you want to describe it, from working from home when commuters, and this is super commuters, but I think there's a big old correlation. Slowly growing, from 2010 all the way to 2019, but all of a sudden, when the pandemic happened, it went from basically 3.1% of commuters who travel 90 plus minutes to and from work. That dropped down to 2.4% in 2021. That made sense. Again, a lot of people, if you're commuting, you're, the term essential worker got so, I don't even know what it means anymore. But you've got to be wherever you got to be. You're doing some physical work maybe, or just your presence is required, as all jobs used to be. But a lot of people are still going to have to, make that commute. I mean, if you're a framer or a plumber, you're not doing it over Zoom, so you're still having to, drive a ways. Now, but it has reversed from 2021. We have seen a reversal. Now it's 2 points in 2022, so we're missing a year and a half of data. But in 2022, that number bumped up to 2.7%, coming closer to the trend of 2019. The 2019 level of 3.1%, and really back at the 2018 level, which was at 2.9.
Yeah, it does seem like from 2021 to 2022, that jump off signals maybe it's return to the office, or at the very least like a reduction in remote work. And it will be interesting to see the implications, because I think it does have clear implications for the development and growth of suburbs. Maybe more people are living in the suburbs, but also for the activity downtown. Because if you're commuting, well, where are you going? And probably going to downtown. This is interesting as it relates to remote work, and maybe not necessarily the length of a commute specifically. I wonder how much of this is driven by just flipping the on switch. I'm going to work now. Although it's interesting to see, if you looked at that chart from 2014 to whenever, the amount of distance, the amount of super commuters increased from 2010 to 2019. At the same time, there was also a gradual increase in remote work, but it was just, I think that it was such a sharp difference during the pandemic, that change. And I think that it was a little bit of a zero-sum game where it did eat into the commuters. A lot of those commuters started becoming remote work, and now they're flipping back on.
Yeah. And I guess a better article or headline for this article would have been, gains back 600,000 super commuters rather than they've gained, because we used to have even more.
Yeah.
Okay, or they represented a larger share. Okay, last piece, Matt, coming from this is from the conference board.
Yeah, I thought
Consumer confidence, Matt, not great. Not it's been lower, but it's not good.
Yeah.
Does it matter?
It is. I don't want it to matter. I think it kind of matters. I mean, it is the index of how much things matter, I guess. It's whatever vibes are. It did tick down, not dramatically so, but it does seem to be hovering at the same level that it's been at, plus or minus, since 2022.
Can I make a quick correlation, not to interrupt you, what you've got to say on it, is that the consumer confidence index is essentially an inverse of like when to invest in something, if you look at the chart. So don't invest at the end of 2007, which was consumer confidence was last peaking. Do invest in mid 2009, which was the absolute bottom for this graph. There's obviously times in between the whole cycle, but it was a pretty good time to invest that period. I guess you could have invested right before the pandemic, but I mean, you're basically just gambling at that point. But basically, for a long period, from mid 2020 through 2021 would have been a great time to invest. In 2020, you made a ton of money. But then the bad time to invest was when consumer confidence all of a sudden skyrocketed back up post, 100 past the 120 of the index, which they use 1985. Whatever everyone was feeling in 1985 is 100, which I guess is like ideal vibes for whatever reason. But so we were way above vibes in 1985.
Yeah.
And now we're kind of back down to we're basically at 1985 levels, whatever that means, or 2015 levels, which whatever that means. It's not bad. I don't think 1985 it was horrible.
I'll be honest.
Or 100 is horrible. It's basically going back to 2016, 2017.
Looking at this graph, I thought that the consumer sentiment would be lower. And maybe I am conflating the University of Michigan, which also has some of the same number or a similar number. Then they have maybe consumer sentiment versus the Conference Board is consumer confidence. However, I remember talking about this a month or so ago about how consumer sentiment was lower now than it was around the time of the Great Recession, around the 2010s, 2007-ish, 2009-ish. But this one, it does accurately, I think, reflect that we're feeling a lot better than we were in the depths of the Great Recession, which is
What's the difference
nice
between confidence and sentiment?
They're all
feeling versus like confidence is a specific. Confidence is like a positive feeling. I'm confident. Where sentiment is like you could have positive or negative sentiment. But it's how you feel.
Yeah, they're all
both,
feelings.
but they're all just feelings.
Yeah.
And so.
Yeah.
They're all just feelings.
Yeah. And ultimately, the way to kind of quantify this is to look at the questions they're asking and how they are weighting each answer to each question. Now, for some of these, like for this Conference Board one, the breakdown is, they have the breakdown there, but they pull out some of it in their release. For instance, their inflation expectations are actually down slightly from 5.4 to 5.3. Worth mentioning in contrast to the broader downshift in consumer confidence, recession risk ticked down to 2.5% by 2.5% too, which is great. Labor market opinions are slightly improved, but family finances sentiment is kind of flatlined. There is some weirdness to these numbers. And that's what it doesn't seem like. Yes, it ticked down, but there are so many goods with the bads. The current optimism on businesses, that's what really seemed to go down the most. So their current optimism went from 20.8 to 19.6. Their future outlook on business went from 13.1% optimistic to 12.6, and then increasing, and then the anticipation of increased income. So they think they're going to get paid more in the future. Well, last time it was 17.7. Now it's at 15.2. So that one seems like the most palpable and like, oh, really? You don't think you're going to get as big of a raise as you were? That's like hit the ground, the ground level opinion that doesn't have anything to do with like, oh, the vibes in the economy. Oh yeah, of course the economy's going to do well. You can kind of specifically point to you'll be thinking about wages a lot more concretely.
Yeah, especially if, again, if wages kind of even up a little bit, and if there is an anticipation of like, oh, I'm going to get a big raise every single year, and employers are all of a sudden they're looking at, they just made a big raise, and the inflation and growth isn't as what it was a couple of years ago. People are might be disappointed if they don't get a big raise, but it's like the business owner thinks it might not be possible this year.
So yeah, all of that kind of in context, I don't get a sense that the sentiment levels are kind of like flatlining or heading down, but I am really interested in seeing, in seeing any difference between, like, I'm trying to correlate it with inflation. That's what I thought you said. Is like, well, you can correlate it as the inverse of what time to invest.
Interest rates.
But yeah. How much does the inflated interest rates, does the price growth that we've been kind of on the tail end, what are the relevant factors there? There's obviously a political element. It's always whenever the other guy's in the office, you always feel like it's a little bit worse than now. And I think that's only exacerbated. That's why I think you may as well throw all these sentiment readings out the window during an election year, because no one's going to really admit that the stock market went up, even though it did. It's like the wrong guy's in charge. I'm going to ignore. I'm going to ignore that. But that's and even also too. This is what has bothered me. And I'm going to get off topic and talk about inflation again. But like, all the people are still talking about grocery prices rising and eggs. Someone mentioned it.
I think you're definitely talking about eggs a lot.
But like, eggs haven't gone up. The price of eggs hasn't really gone up. It's gone down. Grocery prices are not skyrocketing like they have now. I'm going to get a bunch of comments like, well, you aren't going to the grocery store. Nominal all items inflation is lower than it used to be, and I don't know what. So all the comments that I just read, it's because I read an article.
I love you do a man on the street and someone's like, you don't even go to the grocery store, and you're like, I read CPI reports.
I know.
You'd really be able to connect to
this is what
the man on the street.
Infuriates me though is CPI supposedly. And maybe it's wrong.
Think about how messed up their.
That's everyone's prices, though. It's not just your remembering. So I read an article this morning, and all of the comments were like, none of them cited CPI. None of them said any statistics. It was all like, well, I bought a can of Coke today, and it was a lot more expensive than it used to be. It's like, okay, your can maybe, but the CPI, that's our job, is to collect all these prices.
That was the first time. I don't know about you, Matt, but that was the first time I knew that inflation. I was aware of the concept of inflation. The prices went up over time.
Yeah.
I'd never really seen it.
Yeah.
But I remember always, and I'm not the only one, because I've heard older people, my family talk about, when they were buying, a Coke for 25 cents or a nickel or whatever. Well, it's like, I remembered, getting a can of soda was 50 cents.
Yep.
Like universally, like 2 quarters, clink, clink. Clunk, clunk, and you had your can of A&W root beer or whatever. And then when they started, like, remember when they bumped up to like 55 cents?
I don't remember 55. I remember like 75.
Yeah, it was 70. Well, that makes more sense, because I was like, who's got to have it, like the extra nickel? It doesn't make sense. But you got to the 75, and now it's $1 everywhere you go.
Yeah,
for a can of Coke.
Well, it's probably more than that.
Probably more than that. But like that's, 100% inflation right there.
Yeah, and that's a good point.
I remember that the price got bumped up, and maybe it was like in freshman year of high school or something, when like the cans of Coke were $75, 75 cents.
And that's a sharp memory.
And I was like that. I was like, inflation. I was like, there it is in the wild. Like I wanted to take a picture of it.
You can see it and feel it, and you remember it so sharply. It's harder to remember, this abstract idea. And that's why, at the same time as I'm infuriated by people that are only citing this anecdotal evidence, it's like, I feel like an idiot myself for just citing numbers without the benefit of these concrete experiences. Yeah. However, you can't throw out these numbers and they do represent something, and I think they represent something powerful that's going on as inflation trends down. That it's difficult to ignore. Now, inflation's maybe it isn't even trending down. Maybe it's just plodding along, but it's certainly not the hand over fist price increases that we saw a year ago. But
No.
That's not what people are feeling. So who am I to say?
I don't think people are not only slightly confused, but again, reticent to make any sort of decision or call other than like, we're just going to keep doing what we've been doing because maybe we haven't gotten, hurt so far doing what we've been doing, unless you bought a bunch of apartments at super low cap rates on floating rate bridge debt back in 2021, 2022. But other than that, you're kind of like, let's just see where this thing goes. Because no one wants to be the one that calls no one wants to be, waving the mission accomplished flag, landing on a fighter jet on an aircraft carrier. When then you're like,
you look like a fool. No one wants to say no when no one wants to say like, hey, actually you don't have a bad time. Shut up, you're doing great. No one wants to say that to people.
No.
And so I feel a little bit like a jerk there, but still.
I mean, you land, you're president of the United States and you land on an aircraft carrier. Yeah. Like that's pretty badass. And it still doesn't work out.
Yeah, it's just a messaging thing. Yeah. They had that banner out there.
It was the banner. It was the banner. Mission accomplished. Which apparently was just like for that carrier group's mission. But it was still, I mean, it was intended to be like
metaphor.
Anyway, oh man, do we need to stay out of politics? We don't talk about politics a lot, but occasionally it does, trickle in just because, there's the intersection of real estate and politics is very relevant, but maybe not the mission accomplished on the aircraft carrier of George W. Bush, but keeping it fun and interesting. Love to hear your comments. List them down below. And if you're not,
can I do one comment?
Yeah. Okay. Yes. Oh, yeah. Oh, let's comment.
So there was one that I wanted you to answer. This is the one. So we talked about RealPage a couple of months ago in the context of the investigation into their alleged price fixing for apartment rentals,
and the fact that the FBI raided their offices and property management company's office.
So they raided property management company in connection to, they think that RealPage has a program that says, hey, landlords across the country, everyone raise their rents at the same time. Now I know I'm oversimplifying it, but that's kind of the broad brush allegations against RealPage. We obviously have a little bit of a different idea, but Kane Payne.
Here, why don't you play the short so people know what we're talking about?
Yeah.
Why did the FBI break down the door and go through their files? I mean, is it terrorism, drugs?
No, this isn't.
What's going on?
This is in connection, reportedly, with an investigation into RealPage for what they think is price fixing in the apartment industry.
I know a lot of the focus is on RealPage and some of the revenue management software, their pricing algorithms that make suggestions to property managers on where to set the price. What's the issue here?
They think that RealPage is telling all these rentals, increase your rents, and the landlords are clicking yes. They're not really thinking about it.
So using information and data to inform pricing decisions is illegal?
That's what they're saying. Allegedly.
I don't see the problem. And you think they even understand?
That's what I was going to say. It is based on a set of assumptions and misunderstandings about RealPage software and about the rental market in general that need some updating. First of which is that rents have declined by RealPage's own data for greater than a year almost.
Why did the FBI break down the door? And Kane Payne 089 4 days ago says, but that's not what's happening. What this company's been doing is much darker than that. And then I said, what have they been doing that is so dark? And that guy did something, but then someone else came back, and then Mal, let you take it over.
Yeah. So this person says, I'm assuming it's RealPage is manipulating the algorithm with false numbers. Should be definitely illegal, sir. The reason, I know it's kind of nice. The reason the prices are up so high is because they are marketing less than they have to boost prices. For example, he has 40 units at $1,400, but the app will suggest selling only 20 units for $1,800. While that's in play, the community starts to increase prices based on the average cost in the area. If the average rental cost starts to rise because of this, they now have the right to up their rental property prices. This now becomes a chain reaction. It isn't fair to the people and should be banned. I think that this response is what made me think.
Yeah, it made me think too. Because I was just trying to figure out exactly what he was trying to say. And the problem is, I don't think many people know how the software works. Unless you were working as a property manager, you probably really don't know. But what do you think he's trying to say here, Matt?
I think he's saying that that RealPage is encouraging landlords to not rent out units, to leave them empty.
Oh, and so there's no availability.
So there's no availability, and then prices naturally grow to the price that you want.
Okay. All right. Stop.
Okay.
Stop.
So
right
wait. Why wouldn't they just leave it empty? The app's telling them to do that. So why don't they just do that?
Where to begin? Well, one, the goal is to make money and cash flow, and it's hard to do that if you have a lot of your units that are unrented at $0.
That's a good point. The goal is making money, not raising rents.
100%.
Yeah.
And sometimes that you're optimizing, and that's why it's called revenue management. It's not rent maximizer. It's saying you have a target, occupancy level, and you're not trying to push rents too hard because you don't want to have too much vacancy. But at the same time, you don't necessarily need to have your rents too low to achieve 100% occupancy at the same time. You want to have a little bit of slack, some inventory available, some room to move prices around. So the other piece is he's just saying that they're waiting for the right to move rents, like they need permission from somebody to increase their rents. Whereas unless you are in a rent controlled area, but even if you are in many areas, you can't raise the rent on an existing resident. On a new lease, there isn't as big of a cap. Every municipality is a little bit different. So what he's saying is, now you've got the green light to do it.
Yeah, they are.
You could have. So he's saying, they should be $1,400. You're going to bring them to $1,800. At the end of the day, it's what the market will support. Yeah. You can put your price wherever you want it, and if you're manipulating it into a way that doesn't reflect the market, you're not going to get buyers.
Yeah, and I agree. That's the ultimate thing is it's whatever the buyers will buy. That's fine. But also good news for the commenter is that it's really hard to leave 20 units open. You're wasting a whole lot of money. 20 times, what is it, $1,400? That's $28,000 that you are losing every month.
But put a cap rate on that, put a 5 cap on that, and you're talking a couple $1 million.
Yeah,
of value that you're so you can move the rents a little bit more on another unit, then you have to raise them on the other. Why wouldn't you just raise the rent in the first place if you can achieve those rent levels? The income, if there are, because it's
$8,000, so that $400 times the 20 is $8,000. So you are sacrificing 28 grand for $8,000. The math doesn't really add up. Now I know there's a period of time in which it may make sense, whatever, but no one's going to make those dramatic changes because it costs. There is a cost to, and that's what I think that is maybe neglected a little bit. When landlords raise rents, they do it kind of a little bit nervously because, is this going to mean less people rent? And so there is a cost. There is a communication that you have from renters where their demand goes down if you raise rents. So you have to be super sensitive. They are not this insensitive, dictatorial, I raise rents now and you have to buy it. No, there is a chance you are kind of screwing yourself if you raise rents too high. And I've regretfully seen it.
It's happened. You get over your skis a little bit and you got to pull it back.
Yeah.
So I think there's just a misunderstanding of how it works, and but it's all fueled by just landlords bad, capitalism bad, eat the rich, and I think it's as simple as that. And we're looking for a boogeyman, inflation. Who are we going to go after? Well, these pricing algorithms and rent seems like a place that would be worth taking a shot at. It certainly is politically beneficial to some folks. I think that's more of the reason than anything.
And it is a worthy reminder now that apartment operations is difficult. Especially, I mean, okay, doing the kind of cerebral cognitive analysis side is one thing, but like when you're talking to property management and you're dealing with everyone's great days and their bad days, and it is hard work keeping these maintained, making sure everyone's happy, doing your job, right, and fulfilling your promises that you made to renters. But that is hard work every day. Not everyone can do it. And a lot of times it's not, this is what I'm coming back to. It's not a passive income business. It's a marginal income business. It's just like a business like any other. We are selling the living experience, the someone's living space, and it's our responsibility that we have not to just sit back passively increase the rents, because the apartments would empty themselves out.
It doesn't work. You got to provide value. You got to provide really great competitive value.
Yeah, it's constant work then that needs to be done.
It's constant work.
They know.
we had in Bloomington, Indiana, Matt. Mm-hmm. Last night there were trees that went down. We had power off. We had power go off at 2 different apartment communities that we own down there.
Yeah. So that's what they were talking about. Mm-hmm. In the.
Okay. I mean, we've had AC unit. We had people come through and just vandalize AC units this summer.
Yeah.
It just the list. I mean, you've dead bodies, evictions. I mean, it's like. It's
apartment operations. That's what I was going to say. Anyone that's in property management, especially like someone with a lot of experience, they've seen, again, they see the great moments in lives, they see the bad moments in people's lives. You live your whole life in your home.
Yeah.
and so that's what these people are dealing with on a daily basis at scale. It is par for the course.
Day in the life, Matt.
I know.
Day in the life.
Hey, subscribe to The Complex if you want a real slice of this.
Yeah.
Our Director of Property Management, Katrina Green, she runs through everything, and she is brilliant, and I can't say enough good about.
If you want the inside scoop of how the rubber meets the road in the day in, the day outs, but also just strategy of how to be, whether if you're in the industry, you just want to learn more about it, how it works, the types of relationships, the vendors, what it's like actually managing these large apartment communities. Yeah. Again, if you're an investor wanting to learn more about that side of the business, because there's so much focus on underwriting a property and raising capital, and that's all great and important. That's all the stuff you do in order to, that's like to get admission to the show. Like now you got a ticket. Mm-hmm. Now you've got an apartment. What are you going to do with it now? You've underwritten it. You've raised the money. You're able to get it under contract. Again, all that's hard work. I mean, it's what I focus a lot of my time on. It's a lot of, but then what?
Yeah. Mm-hmm.
But then what? You're doing the thing. It's like you're planning it. The planning isn't like that's all that is. That's what the planning. I've got to go plan. I got to get the money. I've got to put this together. I'm going to organize this. Okay, now we're going to go execute. Mm-hmm. That's where it gets difficult, and everyone's like, well, I got somebody that's going to execute the whole thing for me. Sometimes that works out. Sometimes it doesn't.
To really differentiate yourself.
But it's so necessary now to keep your head above water. Yep. Whereas a couple of years ago, it wasn't, because expenses were flat, cap rates were gradually compressing, and then they just compressed by a whole lot. It was much easier than it is today. Yep. Which now is the time to build that muscle and get some great deals.
Yeah.
And so I don't know if you'd like to check out The Complex, and if you're a accredited investor, we do have a deal going right now. Hop on over to solanaindy.com. It's a beautiful 384 unit luxury apartment community in Indianapolis, Indiana. Buying this thing at a 25% discount. It's somewhat of a distressed seller, getting a great deal, newer property, great business plan, 16% IRR projected return, strong cash flow. I'm putting, the GP's putting over $2.7 million in the entire deal, cash. Check it out. Check us out, greatcapitalllc.com, or go to solanaindy.com to just learn more about that deal. Love to have a conversation with you.